Welcome to Talk Tickers. Today, we are digging into Quantisan Group's fourth quarter earnings. And let me tell you, this was not your average earnings report. The company just announced a massive, complete strategic pivot, selling off its main business to go all in on something totally new. Let's get right into it.
Okay, so to really get what's happening here, you've got to understand just how huge this change is. Quantisan, which made its name as an online learning company, is literally getting rid of that entire business. They're rebranding to Here Group and betting the whole farm on the world of pop toys. We're talking those cool, artist-designed collectible figures. This isn't just a little side project, it's a full-blown reinvention.
So with this bold new vision and a profitable quarter, how did the market react? Well, basically with a collective shrug. The stock actually dropped about 2% after the announcement. And that, right there, is the big puzzle we're going to unpack today. Why did strong profits get met with such a lukewarm reception from investors?
All right, Section 1. Let's break down these financials. Because this earnings report was really a tale of two completely different stories. You had the top-line revenue number looking pretty scary, while the bottom-line profit was surprisingly solid. So, let's start with that top line. Revenue cratered, falling 38.2% year over year to about 618 million RMB. Now, look, this huge drop wasn't exactly a shocker. It's what happens when you're intentionally winding down your main business. But still, when you see a number like that, wow, it's always going to make investors a little nervous.
But, and this is a big but, here's the other side of the coin. The company actually posted a really strong net income of 108 million RMB. How'd they do it? By getting super aggressive with cost cutting. You can see it right here on the chart. Sales and marketing costs as a share of revenue plummeted from almost 70% down to under 48%. That's a huge shift, and it shows they're serious about moving away from their old, expensive business model.
Now this chart, this really tells the whole story, doesn't it? That big purple slice is the old online learning business, still making up almost 3/4 of the revenue. But the company's entire future, that new pop toy business, it's that tiny little sliver of blue, just 11%. It's a tiny seed from which management expects a giant force to grow, and they expect it to grow fast.
Okay, so that brings us to the next big piece of the puzzle, management's new story. With the old business on its way out, they spent pretty much the entire earnings call trying to get investors excited about this new pop toy vision.
The CEO, Peng Li, he did not mince words. This quote really gets right to the point. I mean, this is a total 180-degree turn from their old playbook. They're saying goodbye to the high-cost, traffic-driven world and hello to a product-driven one because they believe the pop toy market is just a much bigger, better opportunity.
So how are they going to win? Well, their plan isn't just about cranking out toys. It's about building what they call an intellectual property or IP moat. And the strategy has three main pillars. First up, they're developing their own original brands, like Wakaku. Next, they're locking down exclusive licenses for other popular IP. And finally, they're building buzz through major partnerships with huge names like Universal Studios.
And this is where things get really interesting. Because management didn't just sell a vision. Oh no. They put some absolutely wild numbers on the table, which created this real disconnect with how the market reacted.
Just take a look at this guidance. They just did about 66 million RMB in pop toy sales. For this coming quarter, they're guiding for 100 to 110 million. Okay, nice jump. But for the full year, they're guiding for 750 to 800 million RMB. Let me just repeat that. They're basically saying they're going to grow this new business by more than 10x in a year. That's not just bold, that's audacious.
And that is why the market is so hesitant. You've got this incredible promise on one side, but on the other, you have just a mountain of execution risk. Can a company really throw its main business overboard and scale a brand new one by tenfold in a single year, especially in a totally new industry? That's the billion-dollar question that investors are wrestling with right now.
Okay, so that brings us to our final section, the next call. Here's our take on Here Group, the company that used to be Quantisan.
The debate around this stock is actually pretty simple. If you're a bull, you're looking at a company with a ton of cash on hand that's ditching a slow business to chase a hot, high-margin consumer trend. But if you're a bear, you see a company taking a massive, massive gamble on a fickle market with absolutely no safety net to fall back on. And you know what? Both sides have a really good point.
For exactly that reason, our rating is market perform. The potential reward here is huge, for sure, but the risk of things going wrong is just as big. This is what we call a show me story. Basically, the market is saying, great story, we love the ambition, now go out and prove you can actually do it. Until they do, the stock is probably going to be stuck in neutral.
So what's the trade idea here? Well, buying shares in Here Group right now isn't a bet on their last quarter. It's really a venture capital-style bet on a total corporate reinvention. When you boil it all down, the question you're really betting on is this. Can this management team, who built a successful but now shrinking internet company, really pivot and become a trendy, high-growth global toy brand? If your answer is yes, then today's price might look like an absolute bargain a year from now.
And that's our breakdown of Here Group. As always, this is just for informational purposes. It is absolutely not financial advice. Please do your own homework before making any investment decisions.